Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, we're working on your financial freedom. On today's show, I'm going to go after the California real estate market. You heard me correctly. I'm going after the California real estate market. Now, it doesn't mean I'm going to go out to California and buy something out there. And there's a variety of reasons why I won't do that. You want to hear them? Okay, I'll share some of those reasons with you. Well, the first major reason is that I can get better returns on my investment by investing anywhere but California. Yeah, and on today's show, I'm going to share some numbers with you that I think are going to shock you. The other reason I don't invest in California is that pricing in comparison to rents are way out of whack. I mean, they are way out of whack. MASH Advisor published some statistics. And the statistics that they reported as of September 2020. Okay, so these stats are a little old, but roll with me here because it really doesn't matter what sample data set I pulled. The median property price in California is $843,751. That's the median property price. That means it's selling, the median property, half or above, half or below, are selling for $465 a square foot. That's pretty pricey real estate. As a matter of fact, median pricing in California was up 5.5% from the prior month. I mean, that's pretty significant, don't you think? That tells you that, okay, maybe prices are going up there. Now, of course, they didn't give me information based on, was that month over month or was that based, anyway, it doesn't matter. We know that prices in California tend to go up faster than in other parts of the country. And I know that because I lived in California for a majority of my life, so I saw all of this happen. Now, the traditional rental income, in other words, the rents that you receive, works out to be $2,842 a month. And based on their analysis, they believe that the traditional cash-on-cash return, based on these statistics, at 2.2%. Now, MASH Advisor goes on to say this. They say, as you can see, the California real estate market is doing well. House prices continue to climb, and California real estate investors are earning more rental income and an increasing return on investment month to month. That's what MASH Advisor said. And you know what? That's what they think. However, I think part of the reason that California is doing so well is the fact that there's a scarcity of homes on the market. As a matter of fact, the number of homes available for sale in California in September of 2020 was right at 36,100 units. And that was down 31% from the previous month, according to the stats that they have here. Now, I think that's a pretty significant drop in a month, but because of coronavirus, people are not selling properties. People are holding on to properties. Also, people have been able to buy properties at very low interest rates. And there's concern that, if they sold that property to buy something else, maybe they wouldn't get the same attractive interest rates. Maybe those interest rates would go up a little bit higher, which would impact their purchasing power. Here's the other thing. When there's a lack of inventory on the market, in other words, there's more demand than there are properties to go around, that stimulates the price. It drives pricing up. It's a supply and demand thing. So I think we're seeing price pressure moving upwards based on supply and demand. But that's happening across the nation. I think the numbers are just skewed a little bit more in California because of that average, or I should say the median property price at about $843,000. So what we're going to do on today's show is we're going to get into the numbers. We're going to do a Texas versus California contest. That's right. We're going to have our own little get together here, real estate versus real estate. And what we're going to do is we're going to talk through the numbers, because I want you to understand that whatever you think real estate investing looks like, you may not have it right. And I know this for a fact because I used to invest in real estate based on reading some books and following somebody's program for no money down that didn't give me good, substantial support. And I ineffectively owned and operated properties. And when I became a member of Lifestyles Unlimited, I learned the correct way to do it. And what that did for me was it radically changed my returns. Radically changed my returns. And if we have time later in the show, I might actually share some of those things with you. But let's talk about this California property. Now, again, I am using the data set that Mash Advisor put out there. Okay, I did not go out and do a bunch of research on California real estate. I am just using their numbers because I think their numbers are sufficient. So what I'm looking at, if the median property price per house is $843,751 in California, if that's the asking price, you're probably going to pay a little bit more. So I just said, okay, let's just raise it to $850,000. You're going to buy a property for $850,000. And to do this, you're going to need to get a loan because you're probably not going to do it the Lifestyles way. You're probably just going to buy a property that looks like it's in decent shape. You're going to pay full retail value and you're going to get a loan. You're going to put 20% down plus your closing costs. So all in, you're going to need $170,000 for that down payment, and I'm estimating about $51,000 for all your closing costs so that you can get a really good interest rate. We come back from the break, I'm going to tell you what those returns look like. Stick around.
Warning. Listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
Welcome back to the show. So it's Texas versus California in the Grand Investing Championship. Who do you think's going to win? Well, all eyes right now are on California because California's got those beautiful beaches. It's got great wine. It's got things that California has. And part of the problem with California is that the price of real estate has gotten ridiculously high in comparison to what you can command in rents. So if you buy property in California for investment purposes and you do it whatever you think is the correct way, you can make money on that property. You actually can make money on that property. And I'm going to prove to you today that you can make some money on that property. As a matter of fact, I believe that you can double your money in 5 years. If you buy one piece of real estate in California, you rent it out at the traditional rental income average number that Mash Advisor provided to me, and you hold that property for 5 years. Now, if you've listened to this show before, you know that I talk about the 5 different ways we make money in real estate. The most important one, cash flow. Because cash flow is that income stream your business is providing. Now, your California property is going to have cash flow. It will have cash flow. But it's not going to put money into your pocket. It's actually going to take money out of your pocket. See, when you buy this California investment property, you've made a commitment to yourself that you're going to subsidize the cost for your resident to live there because you're not going to be able to charge enough rent to even cover the mortgage payment. And because you most likely did not buy that property the way we would buy property at Lifestyles Unlimited. In other words, we would go in and we would fix up everything that could go wrong in the next 5 years. You probably need to factor in a maintenance budget. And I would suggest that a maintenance budget for a property that you haven't personally fixed up maybe could be in the neighborhood of $500 a month that you set aside as reserves. So that, when that water heater goes out in year 2, because it was already 14 years old when you bought the property, but the way people are buying property right now in California is like they're so desperate to buy something because it is a seller's market that they waive inspections, they waive everything. They just want that property. And even though that property looks like it's all clean and dandy and all fixed up, you've got to be very careful. You've got to beware of people that are called flippers. Yeah, flippers are people that go in and they buy residential income producing property at a discounted price because it's got issues. I mean, they do the same thing that we do as real estate investors. The difference is this. They fix it up to make it marketable, to make it appear that it's good to go. And they may shortcut some things along the way. There may be some things behind the walls that you don't know about because you didn't do the renovations yourself. You don't know. You're relying on their honesty. And I'm not saying they're all crooks because they're not all crooks. But I will tell you this. There are flippers out there that will cut corners for the sake of making their profit. So you're going to buy the California property. Here's the way the deal is going to go down. So let me just share with you the deal flow. And I'm going to do it the exact same way I do properties when I present them to you. So there's no difference here between the California side of the arena and the Texas side of the arena. So using Mash Advisors numbers, I'm saying that the ARV of your property is about $843,750. That's their number that they put out. That's the median property price. And, if you're buying somewhere like, I don't know, San Francisco, I don't even think you can get close to that number, to be honest with you. I think you're going to pay more. Maybe down in the Los Angeles area, you can find properties for, $850,000 that you can rent out. Your initial equity, because you overpaid for the property, for the right to own that property, your initial equity is $6,250 in the red. Because now you've got to wait for natural appreciation to occur so that the fair market value of that property actually matches up with what you paid. So initially, you're already in the red getting started. You're going to put $170,000 down because you're going to get a great and attractive interest rate. I'm going to use the number of 3.625 because that's what I think is a very good rate in today's market. You may be able to get better. You may not be able to get as good. But if you're a Lifestyles Unlimited member, that's probably the cost of money that you're going to pay. And along with that cost of money, there are closing and holding costs. There are going to be some additional fees that you're going to pay for points to get a better interest rate. So I'm estimating your closing and holding costs at $51,000. So altogether, you're going to need about $221,000 to do this deal. That's almost $250,000, okay, to buy one piece of property. Now, you've bought that property. You probably didn't do anything to make it ready because maybe you bought it from a flipper and, hey, it looks good. Looks good to me. So now you're renting that property out, and the average rents that Mash Advisor provided me was $2,842 for this rental property. Your mortgage, $3.625 mortgage. That mortgage is $3,100. Actually, that number is a little bit low because what we have to do is we have to go in and we have to add additional costs. But just the principal and interest, $3,100. So you're already upside down $759 when you include maintenance costs that you set aside. And we haven't even put in property taxes, nor have we put in insurance costs. So you're already starting to see that this property is going to bleed. But you're in it. You're in it to win it. You are dedicated to making this property work. So you're going to work hard to make it work because you know property values are going up. You're buying for appreciation. But I'll tell you this. As soon as you saw your cash flow number going negative, that should have been a red flag to you. A red flag that says this is not the way to do it because you're going to work and earning money so that you can subsidize the cost of the property that you own so that your resident can live there at whatever fair rental market rates are. So every month, you're going to put additional money into this property. When we come back, I'm going to tell you what that number really looks like. It's going to scare you. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. All right, right now we're in the third quarter. California is a little bit ahead of Texas. California is making a bold push. California is saying, you know what? This is the place to invest because when our property values go up and they go up magically overnight, you need to be a part of that. You need to be a part of the appreciation machine. And you know what Texas says to that? No. Wrong answer, son. All right, let me get back into this California deal. So as we were going to the break, I was talking about the framework of the deal based on what I saw from MASH Advisor and the numbers that they put out. So your cash out of pocket to take down this one particular property, $221,000. I want you to keep that in the back of your mind because if you have $221,000 you're looking to deploy in real estate, this is one course of action. You can deploy it into an asset in California that you're willing to overpay for, waive any inspections on, just so that you can get that asset and you can start renting it out and operating the property. And if you're going to hold this thing for 5 years, let's talk about the numbers. Let's talk about what happens. Let's talk about the mechanics of the finances. So you're getting $2,842 a month in rent. But here's the problem. The costs associated with operating that property are not good. They're really not good because here's the thing. Your mortgage is going to be about $3,100. So right there, you're already upside down about 250 some odd bucks. Then, because you didn't fix that property up, you didn't put capital in that property when you bought it, you need to budget for maintenance costs because those things can happen. I'm just going to throw a number of, I like to use the number 500 for a big property like that in California. But I'll tell you what, I'll be gentle. I'll go with an even lower number. I'll go with a number of, say, I don't know, $200 a month. So, I mean, if you think you can get by with repairing your property for $2,400 a year, I'll give you that. The next thing that you need to take into consideration is that you have to pay taxes. There are property taxes due on that property, and you're not homesteading anything. This is investment property, so you're not going to get any breaks on the property taxes. And according to smartasset.com, they recommend that you factor in your property taxes in California to be 1.25% of the sales price. Yeah, so that takes a base rate of 1% overall that includes local taxes, which can be around 0.25%. So that number is $885 a month. And you need to insure that property against peril. In case something bad happens, you want to be able to replace that property with brand new construction, and you want to make sure you have loss of rent insurance so that you don't miss any income streams. Yeah, because trust me, if this thing burns down, you don't want to miss any income streams. $850 a month for the insurance. Yeah, because this is an expensive piece of property, so it costs more to insure. So when you take into account all of the expenses associated with operating this property, you're upside down $2,500 a month. So you need to be prepared to pay $2,500 a month every month so that your resident has a great place to live. Yeah. And I hope you have a great resident, because if you don't have a great resident, California is not a landlord-friendly state. Yeah, if you have a not-so-great resident, they could create problems for you if they don't pay. But let's get into the numbers. Okay, so what are you looking at here? Well, you've got an annual cash flow of negative $30,000. So you put $221,000 into this property, but you can also afford, because you work in California, you're probably making $200,000 a year, because money's crazy in California, right? But so is the cost of living. So you can carve out $30,000 a year, because this asset is going to do great things for you, right? It is going to make you money over time. Remember, we're on a 5-year hold here. So you're going to lose $30,000. Yeah, that's your negative cash flow on the property. You're going to get depreciation write-offs of about $24,500. Now, you're going to have to talk to your accountant as to whether or not that depreciation is going to do anything for you, because there are specific rules on what you can and cannot use depreciation for, especially if you're not a real estate professional. So make sure you get that information. So we're buying this property because it's going to go up in price, right? And you know what? I am going to actually do some adjustments on my numbers, because normally, well, you know what? I'm not going to do any adjustments. I'm not going to do any adjustments because normally, because I need to compare apples to apples, right? So normally I say properties tend to double in value every 20 years. And when you do that backwards math, it tells you that 3.5% is a good number for appreciation. Now, California's numbers seem to be a little bit higher. They seem to be like maybe, 5% or 5.5%. So I'm just going to stick with my normal numbers because I want to compare apples to apples, but I'll even give you a break later on, and I'll do some adjustments when we go to break to make this deal even better for you. But here's the deal. The first year of appreciation, if it is truly going up 3.5%, should produce an increase of value of about $29,400, which is slightly less than the negative cash flow that you're paying. So you're kind of balancing out a little bit. At the end of year 2, that property should go up another, say, $30,000. At the end of year 3, $31,000. So your 3-year appreciation target, almost $92,000. Now, I said this is going to be a 5-year hold. So let's take a look at what a 5-year appreciation number should be for this property. I'm looking at $158,000 and change. So your projected value of this property at the end of 5 years works out to be a little over $1 million. $1 million. Not bad, huh? You have been the recipient of principal paydown. You've been the recipient of the property going up in value. As a matter of fact, I calculate your principal paydown at almost $69,000. So that's additional equities you're going to command. So let's say at the end of that 5-year period, you've made the decision to sell. And because maybe along the way you joined Lifestyles Unlimited and you learned about how to do 1031 exchanges, you're going to make a decision to do a 1031 exchange when you sell that property and exchange into other properties and move the tax liability, essentially deferring the tax liability into the follow-on properties. Your projected future value in this property, remember I said it was a little bit more than $1 million. Actually worked out to be $1,002,000. Let's just say it's $1 million. Your original loan that you took out was $632,000, actually $633,000. You're going to have an additional $69,000 worth of principal paydown. So now your revised loan balance is $564,000. Your equity at sale is $438,000. Now we're going to take 8% for costs of closing, about $45,000. So your adjusted 5-year capital gain is almost $400,000. That's a 131% increase. But wait a minute. What about that negative cash flow? We'll address that at the end of the break.
We're we're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Welcome back to the show. All right, we're in the fourth quarter. California is doing everything they can to take charge and win this competition of investing in California versus investing in Texas. So let's get back to the field of play. As we went to the break, we talked about these great gains that the California property will make. And I said that I would calculate the future projections based on 3.5% because that's what I do for the properties that I look at in Texas. That's a realistic projection based on what the market's potentials are. But admittedly, California threw the red flag out and said, our appreciation is higher. You need to use the higher rate. And the officials agreed. So I went back and I changed my numbers. I looked at the appreciation based on a 5.5% projection, which gives California a little bit of an edge. But let's see how this all plays out. So at the end of 5 years, keep in mind, you invested initially $221,000 into this deal. You didn't do it the Lifestyles Unlimited way. You did it the way you think you need to do it because you wanted to get into that California market. And along the way, you're paying almost $2,500 a month in negative cash flow to operate that property because you're banking on appreciation. It's okay to lose money every month, right? That's your mindset. Well, at the end of 5 years, you will have paid out almost $150,000. You heard me correctly. $151,000 in additional capital into this investment. So now you're all in it for $371,000. That's right. See, you keep putting capital into this investment because it's going to go up in price, right? So let's take a look at what the price does. So when we went to break, I think I gave you a number of a 5-year return of 120%. Now, when I readjusted the numbers and I gave California the benefit of the doubt, and I said, okay, we're going to go with 5.5% annual increases, because that's what Mash Advisor said California market's doing as far as appreciation. Your return on investment is now 190%. 190%. That's right. But keep in mind, you put $371,000 into this deal to get that 190%. When you take into account the cash flows, you take into account you have spent almost $150,000 in additional principal, but technically it's not even principal, it's just additional cost. It's operating costs because your rental income streams are not high enough to support operating the property. Your final number comes out to 102%. What that means is that you have effectively doubled your money in 5 years. Effectively doubled it. Now, Texas has been very, very patient. They have been sitting on the sidelines waiting for us to get to this point. Because now what we're going to do is we're going to take a very quick look at what investing in the Texas markets can do for you. And this is day and night. Absolutely day and night. So with $221,000 in your pocket, you can effectively buy 9 houses. Not 1, 9 houses in Texas. And because you buy them correctly, you buy them wholesale, you fix them up, you capture equity in the property because your total cost to buy and fix up is less than the after repair value or the appraised value in the neighborhood. So you capture additional equity. You're not paying full retail prices. And because the markets in Texas produce rental income amounts that are more in line with the price of housing, you're going to get something called positive passive income. That's right. In other words, you're going to have your assets paying you instead of you paying your asset. See, that's what the California people do. They pay their asset. But out here in Texas, the asset pays us. So I'm going to use the same deal that I analyzed the other day. It was a single-family home. You could get into it for, let's see what the numbers, $168,000, about $88,000 to acquire, $57,000 for renovation, closing and holding costs about $10,000. But because you do it the Lifestyles Unlimited way, your cash out of pocket is only $24,000 per property. So when you take that $24,000, multiply it by 9, you're essentially investing the same amount of money as you would in that California property, except now you're buying 9 properties in Texas. And those properties are going to cash flow because the average cash flow that I'm projecting for these properties works out to be $342 a month. Now, when you multiply that by 9 properties, that gives you $3,000 a month in income. And if you can live off of $3,000 a month in income, you've effectively retired yourself. That's the way this works. If you need more money, you just go get more assets. Not a problem. You hold those assets for a while, and then you dispose of those assets and you get more assets. That's the second tier approach. But here's what's happening. $3,000 a month in income streams for you produces almost $37,000 in annual income. You're getting a 17%, you heard me correctly, a 17% return on your investment based on just the cash flow. You want to know what the cash flow number was for the California property? Well, it was negative 18%. So the Texas way basically is the converse of the California way, if that's one way you want to look at it. Now, it gets better because you're going to hold this property for 5 years. You're going to get the benefits of depreciation. In other words, you're going to get enough depreciation coming off of these 9 properties that it's going to cover the income streams of the property. So you're probably not going to pay any taxes on that income. You hold the properties for 5 years. 5 years. In the meantime, over that 5-year period of time, not only has the property gone up, not as fast as California, I kept my 3.5% appreciation rates for the Texas property, but that property, all 9 of them combined, have a future value of $1.8 million. $1.8 million. That's a lot better than that $1 million potential that California property had. Interesting, isn't it? Okay, well, let's get back into the numbers. If you sell the property, your adjusted capital gains after taking costs of sale out is just shy of $700,000. So essentially what you've done is you've taken $221,000 and over 5 years you have turned it into almost $700,000. Your return on investment just on the equities in the property, 222%. Now let's not forget about that $184,000, almost $185,000 in cash flows that you have made on those 9 properties over the last 5 years, because you have to factor that in the returns too. So when you look at those cash flow returns, you're looking at a 307% return on your investment. That's better than doubling, folks. 307% return on your investment, much, much better. So it's decision time. Who do you think wins the real estate investor match? I think Texas wins. I think Texas wins hands down. I think if you've got it in your mind to go out and buy property at ridiculously high prices that cannot control rental income streams that provide you cash flow, you're buying in the wrong markets. Yeah, the property might go up in value, but you're going to keep feeding that property every month. You're going to feed that property that you have negative cash flow. Now, maybe you can find a property that, costs less in California than the number that I used, but your numbers aren't going to be that great. And especially if you're dealing with negative cash flow, because that negative cash flow is going the wrong way. You're going to work to pay for a property for somebody else to live in so that you can sell it and make some money on the back end. And I just proved to you that there's a better way. That by taking that same amount of available cash, that almost $250,000, and going out and buying 9 single-family houses where you're averaging about $24,000 cash out of pocket each property, you're going to do so much better. So much better. I mean, what's better, really? Come on. A 300% return or 100% return? You know the answer. It's 307. Look, I do this stuff because I want you to understand that there's a better way to get to your version of retirement, and it's not doing what you're doing right now. Come check us out. Go to freeworkshoplivestream.com. Listen to what we do. We will tell you how we do business. It will change your life. And remember, it's not the money, it's the lifestyle.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.